Hi, welcome to Let's Talk Forex. In this episode, we give you some ideas of how you can improve your profitability by making small changes to your current trading strategy. I think you'll find it useful, and you'll find it'll provide some insight into things that you may not have thought of before, or maybe things that you have missed. Thanks for listening, and if you have any questions or comments, please send them through to us at podcast@fxscouts.com or reach out to us on Facebook, Instagram, LinkedIn, or Twitter.
Hey, Alison.
Hey, Chris. How's it going?
Yeah, I'm all right, thanks. How are you today?
I'm good. Very hot here in South Africa. Apparently the people in Joburg are like burning up. It's unbelievably hot and humid.
Really?
Yeah.
A bit early for that, isn't it? Isn't it usually a bit later in the year that it gets hot?
Yeah, I think sort of December, January it starts to, and February particularly. But yeah, at the moment it's just, people are really struggling. So what's the weather like your side?
It's winter is making its way into Europe. You know what I mean? It's fine. It's fine. I can't complain. I certainly can't complain compared to, our colleagues in Sweden and the UK, where it's, actually there's snow on the ground, No, it's fine. I can't complain whatsoever. But yeah, no, I'm fine. I'm well. I'm pretty good. What are we talking about this week?
Yeah, well, this week, as we spoke about last week, we want to give our listeners some ideas of how to improve their trading, and not by making major changes or giving, sort of overhauling their strategy, but by giving them some new ideas of minor tweaks that they can make to their current strategies that'll make a difference to trading performance. So it's not a whole new trading methodology, but operational tweaks, I guess we could say. That improve profitability. And these are the low-hanging fruit that many traders sort of miss. They sort of sometimes just miss a big, and I know, I've been there myself, you miss the big picture sometimes, and quite obvious changes that you can make that do make a difference. So I think it'll be quite useful advice.
Yeah, I think so too. Yeah, so let's jump right into it. Like, we've got three things here. The first one is, this is counterintuitive for some traders. The first way really to improve your bottom line is to make fewer trades. Most traders, and especially beginner traders, trade too much. And it's true. Look, trading is fun, right? But every time you take a trade, you are risking capital, and overtrading is often what breaks beginners. You see it all the time. So it's really important to identify the trading opportunities that are going to be the most profitable for whatever trading strategy it is that you developed, and then stick to them. And only those ones. But as like most traders, they make the mistake of believing that they have to be in the market all the time. And that's just not true.
Yeah. Yeah, I think that, I know I've fallen victim to that myself, is you think that you're going to miss opportunities. So you sit there and you wait and you wait and you wait and you kind of get bored. And then you're like, okay, let's just take a trade, maybe this will work out. And more often than not, when it's not part of your strategy, it tends to either fall flat or worse, you lose, And in our business, we often talk about the 80-20 rule. It's something we talk about quite a lot, and it applies to trading too. So the 80-20 rule basically is that 80% of your results come from 20% of your actions, and it's a widely accepted principle in many areas of our daily lives and business. So famous examples are 80% of your sales come from 20% of customers, or 20% of your sales reps close 80% of the deals, 80% of the complaints come from 20% of your customers, and 80% of your wealth is owned by 20% of the people. And the same is true in trading. Definitely 80% of your results, and whether good or bad, come from 20% of your actions. So to avoid over trading, probably could, especially if you stick to your strategy, you could do yourself some huge favors.
Yeah, exactly. So do you really need to trade every day? Is a good way to start with this. You look at which days in the past have produced your best results, and then maybe stick to those days. Do you need to trade as much as you do every day? Probably not. A really good idea as well is limiting the number of trades you have on the same idea. If you're going to take the trade on a bounce off the low and then you get stopped out, and then you try that again and you get stopped out again, stop doing it. right? Don't keep on.
Yeah,
It's not rocket science, right?
Yeah.
Don't keep on making the same mistakes. Reduce the number of trades you take, and I think you'll actually be surprised at how this affects your profit and loss levels.
Yeah, exactly. And it's having the patience to wait for the right trades, not getting into the trade for the sake of trading, as I was saying just now. You want to find your setup, you want to find the signal, then you want to have your trigger and manage your risk. So if you see, like, I don't know, an example I think most traders can probably relate to is if you have an engulfing bearish candle to the downside, which is a signal of a possible bearish move, you might only take the trade if the price breaks past the low of that bar or the next bar, or if it rallies only halfway up the bar, then you want to take the trade. Many traders just see the signal, the engulfing bearish candle, and then they pull the trigger. But what they need is the signal and then a confirmatory trigger that it's the right trade to take. And they sort of get impatient, see the signal and take the trade.
Mm-hmm.
And also you want to identify what makes you the most profit. I remember when I started trading and I looked at my stats, I was quite surprised to find that I generally lost on my short trades and I won on my long trades. And I think a lot of traders find that it's quite difficult to see the market upside down, which is what you have to often do when you're taking the short trades. But this was easy, low hanging fruit for me. And once I realized this, I stopped trying to make the short trades work. I stopped trying to see the market, in reverse or inverted. And I traded long and I took the trades when they were long and I did much better. So basically you want to approach the market with what you're good at, and you want to approach it with the things that have worked for you in the past.
Yeah, exactly. Do what works for you. Do what you're good at, and keep it to those. Keep it to exactly that, and don't try and think outside the box too much. Yeah, keep it simple. It's really good advice. The second point we want to make here is having a hard daily walkaway stop loss. Cannot emphasize the importance of this enough. Some people are excellent traders, fantastic, but they lack the self-discipline to keep their stop losses at a certain level, and then when the price gets close to their stop, they move it. And this is just hope. We were talking about this in a recent episode, talking about hope and how damaging hope can be. Hoping the market will turn for you. And then of course, the 99% of the time, well, not 90%, but most of the time, what you're going to do is you're just going to end up with an enormous loss. Not only is this going to damage your equity, but it's going to do damage to your confidence as a trader as well. So there's some important rules for stop losses. Rule number 1, don't let your emotions be the reason you move your stop. Like your initial stop loss, your stop, any adjustment you make to your stop should be predetermined before you trade. Have rules and triggers in place for moving a stop loss. Don't do it out of panic. Don't do it out of hope. Don't do it out of greed. Only always, if you're going to move your stop loss, make sure there's a rule-based reason for it.
Yeah, that's very good advice. And then, sort of going off that point, if you widen your stops, then reduce your trade size. So if you've got a strategy and you realize that you're just getting stopped out all the time because your stops are possibly too close, especially if you find that you're trading in the right direction, but it just sort of it reverses slightly or pulls back and then hits your stop every time, then just reduce your trade size. Reduce your trade size, widen your stop to give yourself room to accommodate the market volatility and noise. And then obviously with a reduced trade size, you'll obviously reduce your exposure and risk. And when your risk is low, then it gives you a proper opportunity to stand back and objectively look at whether your stop distance is better for that trading strategy. So it's quite an easy way to, just to adjust if you're feeling like your stops are a bit too close.
Yeah. And another good thing to think about is whether to trail the stop. So trailing your stop means moving in the direction of a winning trade. So this locks in your profits and helps you manage your risk if you add to your open position. They're not appropriate for every trade, but they're really good in trending markets, especially when indicators like the RSI or the stochastic show that there is room for the trend to continue, i.e., so it's not an overbought or oversold territory. Yeah. So, definitely worth something to look at there.
Yeah, particularly on, as you always talk about, Chris, C Trader, it's great because you don't have to monitor the the trading stop all the time, or you don't have to be connected all the time on CTrader because the stop is set from not from the terminal side. So
yeah,
really
set from the server side.
Yeah, exactly.
No, it's fantastic.
And the last low-hanging fruit, and something a surprising number of traders forget, is to look at the higher timeframes when performing analysis. I mean, this seems pretty obvious, but before you pull the trigger on a trade, look at the longer-term time frame and how the market is trending. You don't generally, unless that is part of your strategy, want to go short on a long-term uptrend or long on a long-term downtrend. So just be aware when you do your analysis that you look at these higher time frames.
Yeah, exactly. With time frame analysis, you can make use of so-called higher time frame, higher time frame and one lower time frame, and then the higher time frame is used to analyze longer term chart and trend context to get a sense of general market direction and sentiment. So you want to establish a directional bias, so it's a long, short, and neutral on the higher time frame first, and then you go in to look for specific trading opportunities on the lower time frames. So you can use this to time entries, manage trading positions, etc. So one of the biggest mistakes traders make when performing multi-time frame analysis, starting their analysis on the lowest time frame. So you can start on the 1 minute or the 5 minute, then working their way up. This is called the bottom-up approach, and is not particularly successful.
No. Yeah, I mean, so if you start your analysis on the lower time frame where you place your trades, it creates a very narrow and one-dimensional view, which basically misses the point of multiple time frame analysis. So often traders adopt a specific market direction or opinion on their lower time frame, and then they do the higher time frame analysis, but they just use that for a way to confirm their opinion, rather than actually sort of having a clean slate, starting from the higher time frame and moving to the lower time frame, and having that in their awareness before they decide on a trade direction.
Yeah, exactly. You create confirmation bias, and it's unnecessary risk that you're building. So yeah, we recommend the top-down method. With this top-down approach, you always, start the analysis in the higher time frame, get a general sense of the market, trend context. You become aware of important price hurdles, support and resistance levels, stuff like this, and then you can dig down into your trading opportunities. And then that your trading opportunity is going to fit into the larger narrative. You're reducing your risk there.
Yeah. So it's pretty short and sweet. But in summary, if you want to if you want to improve your trading performance in 3 quite easy ways that you don't have to overhaul your 3 strategy, your trading strategy, then you want to reduce the number of trades you take and be very specific about the trades that you do take. Ensure that they match your trading strategy. Secondly, you want to set a firm daily stop loss limit, or at least have predetermined triggers for moving your stop, or ways that you can manage your risk if you're going to move your stop. And lastly, you want to be aware of the higher timeframes when performing your analysis. And you want to start with the higher timeframes when performing your analysis, even if you are going to trade on the shorter timeframes.
Exactly. Nice and easy, nice and simple stuff. But I think it'll make quite a difference. If everybody listening to this put these in practice. And next week, we're continuing the theme with one of these, where we'll be discussing stop loss strategy.
Yes.
And how to place smarter stops. I mean, we discussed it briefly there, but we're going to go into more detail.
Yeah.
So hopefully that will assist our listeners too.
Yeah, and talk a little bit about stop loss hunting. It's something I think a lot of traders are quite interested in.
Yeah. No, that'll be fun. Cool. Well, I look forward to it, Alison. You have a great week ahead. I'll speak to you then.
Sounds good. Cheers, Chris.
Cheers.